Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we got our eye on the future. We're going to tell you how the next couple of months are going to go. Let's dive in.
Trade Genius.
All right, Bob, so we got a lot of tailwinds going into the end of the year. I think we've been pretty consistent with our agreement that we're probably going to finish the year up and then some follow through into January. But after January, things get a bit interesting.
Yeah, I mean, even into the middle of January, Phil. So we want to kind of share with you, the market is not as mysterious as people make it out to be because, the option flows have been really driving the market activity. And I guess the first chart I want to put up there, Phil, is to show people the historical option volume and, implied volatility. And the best way to read this chart is that traders like to sell the peaks and they like to buy the bottom of volatility, not stocks. And they tend to work in reverse, Phil. So if you think about it, if you look at far to the right of this chart, you notice how volatility collapses into Christmas.
Yep.
This is why it's hard to short the market going into Christmas because the traders are shorting volatility. And when you short volatility, you create a natural lift for stocks because they're perceived to be less risky. And traders that are hedging, as time goes on, you probably heard these words now ad nauseum, Vanna and charm. Basically what it's saying is that if volatility keeps collapsing, it gets more calm, it drives stock prices higher. Charm means as you get closer to the expiration date, all the premium that you have to buy when you buy an option contract slowly goes away over time. And so when you see an area where you're going from high volatility to low volatility, it tends to be a wind at your, into your sails to help you drive the price of the stocks higher. But then when we get into January and February, the road gets bumpier. And there's a lot of fundamental and technical reasons for that, but that's irrelevant. Really just have to watch what the people that are most leveraged to the market, what are they doing and what are they thinking? And so you tend to have a rise here going into the middle of January, but it gets offset this year because we've had a strong stock performance, and it's going to keep the market from going down into that lift in volatility in the middle of January. But you get this high volatility surge at the contract expiration third week. And this is the thing, if you've been listening to all these other guys on CNBC and wherever, is that you get that what they call the window of weakness. This is the window of weakness where the people are going from a high volatility environment to a low implied volatility environment, and it tends to push the market down. And then you get another lift going into the beginning of February, and it pushes it down again. And then March, you get a bottom in the market. That's why we've been saying that November was going to be strong, Christmas is going to be strong, and Martin Luther King is probably the top of the market for the first quarter. And then you're going to have real big volatility into the middle of end of January, big volatility and pushing down into March. And then we have to reassess into Easter because April tends to be a very, very strong month. And the only thing I'll say before I throw this back to you, Phil, is that a lot of guys, when they go into their first quarter earnings, or really the fourth quarter earnings, is just the earnings aren't that good. They throw the baby out in the bathwater and they reset expectations for their earning predictions going into the new year. So it tends to make the first quarter earnings a little bit on the rougher side.
Right.
So that's why we're saying what we're saying. And I'm going to throw it back to you, Phil.
Yeah, if we switch over to the seasonality, this is the implied volatility seasonality, which the line is inverse of what the stock market would do.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
So this is the actual seasonality of the stock market. As you can see over to the far right, we're getting into the end of the year, into December. And seasonality on this chart versus reality has been pretty spot on this year. Just a couple of windows where things got a little divergent, but otherwise the moves have been, you could overlay this year's chart on this and it would be very similar. But then you notice as you go into January of the new year, going over back to the left of this chart, you see that we've got some follow through, and then we have a pretty large reduction in the price action down into the end of the month. That gets amplified when you have a positive year, especially when the year is over 10%. And we've just had like a 15% move higher in the last few weeks, which is pretty historic actually. And we were of the mind that we would get a push and that our recession would be deferred a little later into 2024 for reasons we've explained quite a bit in the last few weeks. But I'm thinking too that when you have the positive year, I don't have the stat up here, but like a greater than 10% positive year is, I think, without fail, a negative January. So you start off January well, and then about midway through, especially after OPEX, is where you need to key in that second or third Friday of the month, and then we get a lot of weakness those following weeks. And that typically, I mean, you have some gyrations, but that typically will continue into March, which lines up perfectly with what Bob had shown in that implied volatility graph. So it's basically the inverse of this, but this all gets amplified because of such a strong year. So it doesn't mean next year, is a disaster, but it does imply that the first quarter is going to be probably a bit more rocky than average.
Yeah. And, a couple points too is that we get to see this stuff dynamically because we have access to the options information and we could see where the open interest is out into the future. And so we can get a sense for how close this is tracking the seasonalities. And the other thing is the wild card this year that we've not had in the past is that we now have a fairly robust bond interest rate alternative to the stock market that is lower volatility. And then number two is that really all eyes are on March because basically the money that the banks have in reserve will all be spent out. And we're just going to have to see whether or not that money is going to come out of the stock market to support the bond auctions that the Fed has, or does the Fed or a foreign actor engage and buy the bonds when the banks are unable to continue, the dealers, if you will, are unable to continue to buy bonds. And so really, I think what we're telling you is probably going to be pretty consistent going into March. Then March is going to be a wild card. And either you're going to see an surge in inflation, which will change what will go up and what will go down, or we get general deflation because interest rates are going to go up because you have to pay more to attract investor interest. And it's going to be a direct correlation, inverse correlation from the stock market into the bond market because money has to come from somewhere to pay for these higher yields. So that's kind of what we're thinking. So I think there's going to be between now and the end of March, it's going to probably be three areas, I think, of strong weakness and three areas of strength. And Monday, Tuesday, Wednesday next week is one of those areas of short-term weakness. And then we're probably into Christmas, into the middle of January, it's going to be a window of strength again. And then January, mid-January to beginning of February, it's going to be another weakness area. And then February, the second, third week into March will be an area of weakness too. So that's what we want to share with you guys. So Phil and I aren't pulling this stuff out of our hat. Okay. This is what we follow. This is what we trade. And just because we think the economy is going into recession and we want you to protect yourself, this is how the market reacts to a lot of leverage in the system. Now, all bets are off with a black swan, but this is pretty much what the traders see. And you don't fight the traders unless an outside event comes in and disrupts these data points. So Phil, that's what I want to share today.
Sounds good. Let us know your thoughts down below in the comments. As always, please hit like and subscribe and check out our specials over at tradegenius.co. Love to see you in the room and help you navigate these markets. Thanks, Bob. And thanks, guys. We'll see you guys on the next podcast. Take care.
Trade Genius.